Good morning, traders. Welcome to the Flow Show, Monday, 7th of October. Kick off a new week and see what's going to happen this week after Friday's fun and games. Hopefully we get plenty more of that this week with some decent data out as well. Morning, Mr. K-Man. Welcome back, sir.
Good morning, Ryan. Good morning, everybody. Yeah, glad to be back. Yeah, indeed. Been a bit volatile while I was off, so there's going to be plenty to talk, not in the least about the Friday surprise. So good to be back and in your company, Ryan.
Yeah, likewise, mate, likewise. And hope you don't suck any volatility out now that you're back.
Oh, yeah.
We've been enjoying it.
Count on that.
Right, let's get cracking. China, their Chamber of Commerce has obviously expressed their dissatisfaction on the EU's decision to lump more tariffs on electric vehicles. They've urged the EU to delay implementation of those tariffs. They are still negotiating with the EU and the technical teams are going to be continuing talks this very day. So we'll wait to see what happens with that. But for all intents and purposes, it looks like those tariffs are going on. And we've had obviously no end of car firms moaning about it, countries moaning about it, Italy, Germany, saying they don't want to have trade wars with China and they should take a more cautious approach. All book talking, of course. What's coming tomorrow? China's still on their hollybobs, so they're back in play tomorrow, particularly. Apparently, we are potentially going to get officials briefing us or briefing their population, and we'll hear about it, on a package to promote growth. So they want to keep that ball rolling. So they sounds like they're going to be coming out with a load of stuff tomorrow, which will probably be overnight for us, on what they're going to do to boost growth on top of all the rate cuts and stuff they've been throwing at it. So I suspect we're going to see another big open in China's stocks tomorrow. It won't be a surprise, but just keep that in mind if you're trading commodities, commodity FX risk assets as well. We could be getting a little bit of support there from those Chinese stocks and this growth promotion package. So keep an eye on currencies like Aussie dollar, for example. Over in Japan, we're obviously hearing all the bods moaning about the moves in the yen. Volatility still very high, trading at 13.65%. It's been as high as 13.84% in the 1 month at the moneys. After the Fed, we were dropping to the low 11s, but we've ramped right back up. So we've had the new currency man, Mimura, saying that he will monitor FX moves, including speculative moves. So we're back on that bus about speculation. Finance Minister Kato says weak yen has both merits and demerits. PM Ishiba says there's no plan now to change the joint statement between the government and BOJ. They keep talking about this. It's almost sounding a no smoke without fire type thing, but I think a lot of these bods are keeping an eye on the 5-minute charts at the moment and still reacting to every time there's a price move. Now, this is a strange comment, but it might just be something that's been misconstrued, misinterpreted. A comment from Ishiba said, "We'll continue monetary policy to ensure an end to deflation." So I'm not sure, I say, that might be a lost in translation thing, whether he meant fiscal policy or whether he meant the BOJ will continue monetary policy. But that headline in itself, "will continue monetary policy to ensure an end to deflation," sounds a bit strange. On the economic front, the BOJ has upgraded 2 assessments or 2 regions out of 9. So they've upgraded those 2. The regional report now states that all regions in Japan saw economy recovering moderately. Some saw picking up or picking up moderately. And underlying that, these regions said that the broadening wage hikes were underpinning consumption and getting more firms in regional areas to pass on rising labour costs. That's music to the ears of A, the BOJ, and B, the new PM, because that's what they want to do, get out of deflation and keep the ball rolling on higher wages, better economy. One of the branch managers, Nagoya, BOJ branch managers in Nagoya, I should say, not his name, Nagoya, says it's important for FX moves to reflect fundamentals. So these guys are jumping on the bandwagon as well in terms of yen moves. Kay, I don't know how much up to speed you are, but we've had a hell of a lot of talk out of Japan from government, finance ministers, the likes. They seem to be commenting on every price move at the moment.
Yeah, that for one, and also, well, there's a couple of things. I think Ishiba, he has called for elections, right, on the 27th of October.
Yeah.
I think that's already a bit of a pre-election statement, saying that they will continue to do everything to beat deflation. I guess it's more on the fiscal side of things, continue with stimulus and etc. Sorry, but what I did note, okay, there's been those reports out, and then branch managers, they always somewhere comment on, because you got like 9 regions over there, and 2 of them have been the assessment have been upgraded. But I find the new, or say renewed crew relatively quick on the ball. We know that the former crew, of course, they were forced because dollar yen was tanking all the time. But the new ones, they do seem to want to be seen as being relatively quickly on the ball, and I think it's interesting, and it needs to be monitored whether they will up the rhetoric, and therefore it would be good if we get a test. If we get a test of 150, for instance, in the dollar yen, just to name the dollar side of things, because we had those numbers on Friday. So I think that's going to be a very interesting one to monitor, especially if we hear BOJ or more MOF, especially MOF members, Mimura, etc., come up to complain about the renewed yen weakness. That is going to be interesting right now, running into those elections. They may be tempted to try and curb all speculation ahead of the election upcoming this month. So I think we need to be on our toes for all things yen, running up to those elections, which are going to take place just a few days before the next Bank of Japan meeting.
Yeah, no doubt we'll get the odd sources drop from somewhere or other, no doubt. But yes, we know that Ishiba's and his mob have got a far more cautionary slant to things in terms of keeping accommodation in monetary policy there, and we'll see how that's been reflected at the next BOJ meeting, as you say, mate. Right, moving on. Yeah, go on.
The thing is also, there's a difference between being minister of something and then all of a sudden being prime minister, and we've seen it already in Ishiba's way of talking. He's a bit more cautious now than he was before. But yeah, there's I think there is we need to be a bit on our toes to for knowing what's going to happen in the next 3 weeks.
Yeah, very much so, mate. Very much so. Right, yes, over to the RBNZ, and I don't know if this comment has just been a rehash or an old story, because I couldn't actually find any context behind it. But we've had someone reported RBNZ governor or saying the risks to inflation outlook are balanced. It's the RBNZ meeting this week on Wednesday. I'm not sure if they have a blackout period like everyone else, so it's strange to have those comments coming out. But anyway, if that comment was sent out, again, that doesn't suggest that they're going to go any big guns on rate cuts. We're still playing the 25-50 game for those guys. Sorry, mate.
No. I was just I was wondering when I saw this comment how to interpret it. Does or say if everything is balanced, that they can cut big, or what does it mean really?
Yeah, exactly. That's my thinking as well. I don't know. I was looking into this last week because I'm starting up an Aussie Kiwi short because I think the market's too dovish on this, expecting 50s. Just given the last monetary policy meeting, previous comments, it doesn't seem like they're ready to step into a big cut, and nothing really in the economy suggests they need to make that move. But you can't rule it out from these guys. But yeah, I think the market's getting a bit too dovish on this one. But we'll wait and see what happens Wednesday.
On the other hand, if you listen to what Powell said, and if or listen to what Powell said, is once Powell said things are starting to rebalance, that was when they started to cut. So is that the same kind of message that or is trying to send out? And really, I don't know. I think we're heading for a cut, but as you say, it's all open whether it's 25 or 50, right?
Yeah, I mean, I like to give things the pros and cons. The pros to going to 50 is they do have rates up pretty high, 5.25%. So they do have room to cut a bit bigger. And they have mentioned the economy's weakening. But then every other message is saying that they will take a slow and cautious approach, and they want to make sure that cuts are a reduction in restrictiveness, not a stimulus cut. So that's on the other side of the coin. But anyway, he'll be what he'll be, and I'll either have a good trade or I won't have a good trade. That'll be the end of it. But still, the RBA situation to be resolved as well, and they're going to be cutting sooner than they expect anyway. So that's the other side of the price on that one. But yeah, plenty of time to get through that one. Bit of data this morning. We've had Germany. They had a bit of a good week last week, and they've had a bit of a. Where am I? Have I even got the right dates on? No, I haven't got Monday in. See, there we go. I was missing something. Their factory orders went backwards. If I can find it, where we go? There we go. A lovely minus 5.8% drop after an upwardly revised 3.9 last month, so well below expectations and prior month for that. So just when you think Germany had a little bit of a pickup in things like industrial production, well, that's the rug's been pulled out from that one. Germany press, they often get a bit of a heads up on when the economic ministry is going to change their forecast. We already knew that rumours last week that they were going to scrap any growth for this year. Well, German press is reporting that the economic ministry may say that the economy is going to shrink by 0.2% this year, given that we're only 3 odd months away from the end of the year. They should be getting that one right. So that will probably drop later today or in the next day or two. The German economy coming out with their latest forecasts for poor growth. Eurozone retail sales was a bit of data out this morning, coming in as expected 0.2% year on year. Slight miss. Some had expectation of 1%, came in 0.8%. Still, we've got a lot of numbers with 0. This and 0. That on it. So things aren't looking that good over there still. ECB's De Guindos says we cannot claim victory on inflation. Service inflation remains high. It is better to be cautious on rate cuts. ECB's Vilroy had an interesting comment. He said we'll quite probably cut rates in October due to the rising risk of inflation undershooting the 2% target. This is something I'm had my eye on for particularly going into 2025, that if inflation does start undershooting a lot of targets, that's going to blow these neutral rates out the water in terms of what the market will be thinking anyway. So that's going to be the risk. We've already got Eurozone inflation 1.8%, although the core is still well above 2%, but we're still below target. And if it keeps going down, then that's potentially going to force central banks to chase inflation lower rather than just getting rates down and holding them there. Right, coming back to the big deal last week, Friday's NFP data absolutely blew it out the park. 254,000. Unemployment 4.1%, and that was with the participation rate staying unchanged. Wages 4%, higher than last month, higher than expectations. Even on the month, hourly earnings 0.4%. The only negative I could find was this one, an important one, average weekly hours dropping to 34.2, probably the only red number there. Forget the manufacturing numbers, we know that was weak. So a real ball-busted number, and typical for what we're seeing at the moment. When the market starts to see some weak data and get all dovish over the Fed, we get data like this. We saw it with jolts. We keep seeing it with jobless claims. Yes, we had a bit of a softer ISM reports. Those were set for September, obviously. Sorry, those were for yes, those were for September. So they do played into this, but they had no say whatsoever in terms of what happened with this data in terms of employment moving further into contraction in those ISMs. Kate, was it a one-off, or is this going to be a start of a trend? Put you on the spot first thing on a Monday.
Yeah, well, whether it's a one-off, we will have to see. But the thing is also that well, okay, the dollar is higher. This is it's higher than when we were on the numbers. But straight away, people are thinking about, yeah, but it can come out any number, but it will be revised downwards. So in the FX market, the dollar has rallied, but has maybe not so much against the euro, but against some of the other currencies, a little hesitant to keep the gains. I do think it's, regardless how we take it, it is a real good number, and I wouldn't stand still completely at the NFP number, but especially the unemployment rate that came down quite significantly, and I think at least until Thursday, that should, in theory, keep the dollar beat on any dips. That's my feeling right now. And then on Thursday we will see, because the pendulum is now swinging, and less than 50 bps priced in. But that's just the bond market needing to manage their books. But get a lower print on the CPI, they will have to reprice again on Thursday. That's going to that's how I look at it. Going to keep us busy. And yeah, but if we get a sticky CPI on Thursday, then perhaps the dollar could need another serious leg onto what it's built right now. But to me, this is you can turn it how you wish. This is a pretty decent number. Early revisions of the GDP, bit up and down, but they're staying firmly above 2.5%. So that, in theory, should, in my opinion, just keep the dollar bit on dips at least until Thursday, and then we'll see. And there's good enough reasons to well, if we take away those who are really linked to risk, or just like Swiss, for instance, if we look at the currencies, not gold or anything else, but if you look at the currencies, those are really linked to risk, and you could add the yen, and the yen, there are all those comments. But if you look at all the rest, I think yeah, the numbers are not of the likes to immediately curb this dollar move, right? So yeah, I think it remains bid until Thursday at least. Bond market being what it is. I think we can stabilize here around the 4% mark in the US yields. They have ramped higher quite a bit due to that report, and being potentially a little overdone as well on the pricing of more 50 bps cuts, which was a little ridiculous to start with. But here we can stabilize, in my opinion. But stabilizing at a decent level versus the rest is should, in theory, be good enough to keep the dollar on a bit tone.
Yeah, no, I agree with all that. And we'll look at the yield in a bit more detail after we got through all the new stuff. President Biden said the jobs report was good news and they have more to do to lower costs. So he was cheering that one. Now, it really was quite a moment on Friday. Not often see these sort of headlines popping up on the wires. The first headline we got was that traders shred bets for a 50 pip cut in November. Usually they cut bets or reduce bets. They shredded bets. That's the significance of the data. So it went from pricing out 50 for November to moving to less than 25 for November. And now this morning, traders see less than 50 pips of further Fed cuts this year. That comes, as you remember, week or so ago, Powell saying that he expects 50 basis points of cuts to 25s for the rest of the year. So that's now moving against where Powell sits at the moment. And this is the same old pendulum swinging one side to the other. Yeah, boat rocking, Gavin. Everyone's running now to the more undovish / hawkish side of the boat, which means we will probably get an extreme move the other way now, whereas we've got the extreme move pricing all those 50s and getting dovish. Now we're going to run the other way. So no, that's where the market is sitting at the moment. It's looking far more undovish / hawkish than it was before the FOMC. Mr. Excitable, Fed Goolsby, he's usually wondering what's going wrong. Well, everything's going right at the moment. He called the US jobs report superb. He says strong jobs likely to mean strong GDP growth. He says the end of the port strike is another piece of very good news for the US economy. He's been banging on about that, how negative that could have been. Now that's over. He can change his tune again. Then he did go a bit cautious. He says doesn't want to react too much to one data point. Said if we get more jobs reports like this, I'll be more confident we are settling in at full employment. The large majority of Fed policymakers feel rates are going to come down a lot over the next 12 to 18 months. Then he'd said this before, Vilroy, but he's on the same theme. He says there's some signs inflation might undershoot the target. So he's a Fed head who's keeping an eye on that one as well. He said the broad set of data shows that the labour market is cooling. So not to trust one report, as he said. Ex-Treasury Secretary Larry Summers is a bit of a hawk in his thinking. He said the 50 pip cut in September by the Fed was a mistake. Easy to say afterwards, of course, and seeing that data. As you might expect, that pendulum swing has got all the banks to change their views. Bank of America kicked it off after NFP, cutting their 50 pip call down to 25 for the November meeting. So they now expect a 25 pip cut per meeting until March 2025, and then 25 pips per quarter until the end of 2025. JP Morgan also cut their call straight after from 50 pips in Nov to 25 pips. So all those bank forecasts going well as per usual. That's all I have on the headline front this morning. Okay, anything else you've got?
A bit of politics in the UK, perhaps. Starmer needing to reshuffle his cabinet already a bit early. Also, was a report out saying that the wage growth in the UK is the lowest in a while. Perhaps that's worth a mention. But that was maybe already last week. Did you see any of those pension funds or lifers saying that they were nervous about the budget to come? Because I got the impression it's playing a little against the sterling this morning.
Yeah, we might get into that sort of realm where we start looking at the budget stuff. Yeah, it's been a bit of a theme ongoing. We still get all the millionaires calling out that they're all leaving because of potential taxes, and yeah, it's a general undercurrent, shall we say, along those lines. But Yeah, it's definitely looks like it's heading that way anyway.
Okay, I mean, yeah, but I thought it was perhaps noteworthy to today because also I mean I was a bit short euro sterling and I bought them back because of all those little headlines coming in and saying perhaps we know how a sterling market can react, especially that sterling has been like really bid for quite a while, only partially being undone by what Bailey said last week. But yeah, I've got the impression that we may just be at the start of sterling losing a little bit of its shine that we had for literally months, right?
Yeah, exactly. No, you're absolutely right. I mean, what were we trading? Having a look at towards 135.
Yeah.
not, not a not a week ago, and now here we are, and we might be heading to 130s. Such is the nature of the quid; it always moves bigger than the rest of it. Right, well, let's we might as well stick on cable here while we're looking at it. We've got the 50 fib of this August move upcoming, just around 130.50, so we're not far off that at the moment. Then we've got a bigger level down at 130, which is always going to be a big level because it's naturally a fib as well, and that fib is from, oh, if I can zoom it in, that fib is down there from the April move. So we've got a couple of key fibs at the moment. You know my thoughts about fibs. Unless we start breaking the 50, it's not necessarily indicative that the trend is changing. But you know, given the mood of the market now, I wouldn't be surprised to see further downside in some of these pairs versus the dollar, as we said, given the way the pendulum's swinging on the Fed at the moment. But we do have some key levels here, particularly for cable. So keep an eye on those levels, particularly that 130 could be a bit of a maker or breaker for what happens in cable from here on out. And yes, euro sterling is reacting quite a strong pullback really off of that level last week up at the 84.30s, but we're holding it. 83.60s, 70s was a bit of my level there. I've survived my stop on my longs. That's a wonky print there. I'm still in my longs for that one. And we're seeing a bit of a tick up again. So I think we've come quite easily through this 83, 85 level, which was a bit of a extension level going back, which is why I've kept it on my chart. We have knocked around there over the last few days. But back above there, we're getting up to the 84.20 zone. We need to get above and hold that. If we do that, then we're going to see some further upside. But if not, this staying below this 84 figure really will keep us in this area, 83s, 84s for now. Obviously, this budget stuff coming up could have an influence, as Kay's mentioned.
The thing is with euro sterling, it's a bit which one is the least bad now? Because I mean I've got trouble personally to buy euros. That's perhaps already clear, and my opinion still hasn't changed, especially that we see issues in the two biggest countries there, the two biggest contributors, let's say. Germany, we've seen enough, and then France now, budget and things coming up are also not looking too rosy, and then data are what they are. But yeah, I think it could start to be, and I think that today, for instance, is one of those days where we start to see a bit of a weakness creeping into the sterling a bit more than elsewhere. As you say, this level of 83.5, 83.60, bit of a support in euro sterling holding. Yeah, the correction after Bailey, I think, was kind of okay. We also know that sterling can be a bit of a, I think, taking that out of the equation right now. Yeah, I think we need to be a bit careful for sterling, and you might end up having a pretty decent position there if you're long euro sterling. Perhaps why not? You know, looking for that 84.60 again or so. That could be on the cards if the market is really starting to be a bit worried about budgets and Starmer's politics and all. I just want to quickly reply to Angela. Angela, yes, we're starting earnings season, and unless you're interested in PepsiCo, so the banks are starting to report on Friday. Okay, back over to you, Ryan.
Yeah, thanks, mate. Yeah, that'll be a lot of fun. Q3, I think there's a bit of risk for this one because a few banks have been, their forward guidance wasn't exactly the greatest for some of them. I think it was it, I can't remember, it was Goldman Sachs or JP Morgan saying that their trading was down 10% in Q3. That was a few weeks ago, so I'm not sure that we might be in for a bit of a wobbly one from the earnings in Q3, which that'd be important for stocks to watch. But you never know with stocks, even if it's bad news, they still go up. But yeah, this euro sterling, even when we were getting up here, I was thinking this is well overdone for this sort of move. Not enough to turn short, but I was definitely getting profit, taking profit on my longs. Yeah, we hold the fact we're sort of holding this 50, 60 areas, as I said last week, maybe sets up a bit of a range now, just stepping up off the lows here, up here, and obviously keep an eye on that volatility difference between cable and euro dollar. Let's say hello, Ali. You're doing an awful lot. You didn't trade last week. Oh wow, that's a surprise. And you say you cannot make money in Forex if you don't buy my winners, and cannot make money if you don't go big on some convincing trades. Yes and no. You've got to be a bit careful. Just get up in your size because you're a bit more convinced about a trade. There is nothing wrong with that, but don't start getting too far out your comfort zone and going bigger on some and smaller on the others. Your main lesson or your main theme needs to be improving the ratio between winners and losers. Once you do that, then you can get, potentially exponential growth because you're always making more than you lose. And really, then it becomes better to just scale up overall than try and think, I'm going to throw a bit more at this trade and I'm not going to throw as much on another trade, because then you skew your ratios a bit if you start losing on the bigger trades rather than the smaller trades. So just keep the exercise, get that ratio of wins and losses and how much you win versus how much you lose up. And then as your account grows, you can just increase your size. That's the pattern you want to get into, mate. Okay, the size of that, rather than just trying to pick a trade that you think is going to do better than another one. Also note you're long 83.52 on euro sterling. Yeah, go on, mate.
No, I was just laughing at Arif's comment. If it was easy, everyone would be trading. Yes, that's exactly it, mate. I had one of my first bosses ever when I was trading in banks, and that goes back into the 80s. In those days, you wouldn't go to jail if you made certain comments on things, and I have a lot of respect for any for any job. Let that be clear. But he said that if trading would be easy, there would be a lot less road sweepers, and that take apart, as I said, because it's not politically correct to kind of say this right now, but 40 years ago it was. So yes, trading is far from easy, and if it would have been easy, it would indeed. Well, I mean, you know what? If it would be easy, it wouldn't exist anymore because everybody would have found the way to do it, and then you kill a market.
Yeah,
You always
exactly.
need people being on not necessarily on the wrong side, but you always need people who don't get there, because that keeps it a viable market for those who can.
Yeah. Basically, you're saying that the losers provide the liquidity for the winners.
Not necessarily, although we know that if you look at all the brokers, they have to admit now that 65, 70, 75, 80% of people taking positions lose money. But that's because those people have either the wrong mindset, the wrong system, the wrong they're doing something wrong, or are just gamblers. if you go to a casino also what pays out what 15, 20, 25%.
Yeah.
It's exactly the same. If you take trading like going to a casino, then you will be. I'd rather go to a casino actually to have some fun, and then I know how much I can lose straight away. But yeah, it is not always easy, and it takes time. And to continue on what you said in reply to Ali, I said what I really said is not really go big. I said you need a minimum amount of critical mass in your account to be able to use the next or trade the next opportunity. I said literally, I think if that was here, if I recall correctly, I said like if you trade on a too small account, you're not going to make a living out of it. And I think that was your question that day, Ali, saying like you were asking about stuff and I said, like, if you want to make a living of it, you need a minimum amount of critical mass to trade off. Otherwise, you are not going to get there because you can't have 100% winners.
Yeah, and that's an apt time to remind people of our trader funding program, which allows you to scale up your trading, and your risk is really just the assessment fee, of course, rather than putting in that amount of equity yourself, which is it's a good way to do it. Because then you're not risking, if you want a 500 grand account, you're not risking 500 grand actually to put in an account. Okay, so yes, you pay away some of the profits, but it's a good profit share with our TFP, and it just gives you that ability to scale up. But I would say to people, don't try and scale up until you can consistently make money, or you can consistently make more than you lose. Ali, you say it's hard not to trade. I find it very easy not to trade, because I'm not looking for a trade every 5 minutes. If you're getting into that situation where you are trying to find a trade in every pair, every asset, every price chart, every time frame, then you're probably pushing yourself a little bit too much. But different people trade different ways. I'm just been doing this long enough time. I don't have to chase every single trade and every single chart move and price move that I see. But keep up the good work, Ali. Get that improvement going, and then just naturally the profits will look after themselves. Brian, yeah, I'm going to look at Aussie Kiwi quickly. I did start. I needed to scratch the itch last week, so I started shorting 110.40 on this one. Haven't added yet. I am looking maybe for a bit of a push higher before we get to the RBNZ, but I may just increase my position slightly before that. I will look to run it potentially up to the highs here. It's going a bit of a wider view. We've got this 111.76.80 level up here, which is a bit of an on-off level. So I'm going to be looking at that as my first assessment point. If we busted that over the RBNZ, maybe because they've got a 50 and turned all dovish, then I'll probably look to get out. But if they're not too dovish, we'll see. I might run it up to there as a last line and then have a stop a bit high above it. But yeah, I'm looking to maybe run this one over the RBNZ, keep it on for a bit of a trade over at the RBA if they start switching, which may happen. Who knows when? But that's what I'm looking at in that one. In terms of where I want it to go to, well, anywhere below where I'm entered, obviously, but I'll be keeping an eye on the old magnet down at 108 if the trade goes my way. So yeah, really, I'm trading this market view that the RBNZ might do a 50 and get all dovish and whatnot. So that's what I'm looking at for that one, Brian. Kay, how are you set up at the moment? You want to look at a couple, or?
Yeah, I can look at a couple because I know Deresh is here, and then Ali has a position as well in gold, I see. Yeah, I can take over for just. I'm not going to show too much today, but I'm just going to show a couple. Look, gold, and before even looking at the picture here, as I said on Friday, if I would buy dollars, and I'm actually still thinking, well, I've got like very small, but if I would buy dollars, the only one that I wouldn't buy dollars against is gold, because there's too much going on in the Middle East situation. Um, so this is one that I said, like, if I buy dollars because of those numbers, gold is something that I would not buy dollars again, because um, yields can go where they want. But if really this Middle East situation continues the way it goes without improving, and we have seen this morning again, some projectiles flying, and the situation in Lebanon is maybe not done yet. The situation in Iran may not be done yet. This thing is going to hold up, in my opinion, regardless where we end up in yields. And as I was saying in the room as well, okay, we are a bit in a short-term triangle here. So if you want to trade those stakes, you can, and we're roughly in the middle of that little zone. Those 26 and a half. So we're somewhere that I said, like, okay, this could end up over there when it broke above here. But it's still and look ahead at what can happen on Thursday. If by for any reason we get a weak CPI print, I think we're trading 27s if the geopolitical situation is not yet not or not improving by then. Of course, if the geopolitical situation improves, and in the meantime, and then after that, we get a positive like that, meaning sticky also CPI, which would drive yields up. Of course, gold can come lower. Well, it can come down to 2,600. No, it can. But if you look at it from a geopolitical point of view, which has been one of the main reasons why we are up here, it's not improving yet. So if you go short gold here, to me, um, just watch it. I don't know where the levels really are, where I put my stop, where I would put my stop when I'm short gold. But we are in a bit of a similar situation as here. People were saying, like, okay, yeah, we topped out, we topped out, we topped out. We are going to go lower. Well, no, we actually went $150 higher. And for as long and we know the market tends to trade less and less the geopolitics after a while, but this is a different situation. I think the Middle East is bad enough, and then you had a little bit of continuing issues between Russia and Ukraine, and then you had what's happening in the South China Sea, where the Chinese raided those what was it, Vietnamese fishing boats. I mean, I don't see any reason to be really short gold right now. There may be one day, but I would really not be surprised if we go up into those 27s at some stage. So that's just my personal view on this, outside even of what could be seen as we're calming down and we may start to go lower. Yeah, but yeah, I mean, there's stuff behind that are likely still good enough to keep this up. Silver is a bit of a different one, and I really haven't updated everything yet. But I see that we are capping every time we go above 32 and a half. That's still going to be my level on the top side, and I've also got the impression that the market is not yet fully buying the Chinese revival. We've seen that also on the Chinese stocks, but there will be an interesting period upcoming now, and that is going to be the reopening of the Chinese markets, and then we'll really see what the Chinese markets are made of, and then we can start to think about stuff like silver again. Because if the market buys now the Chinese revival, this can actually ramp higher. Another one, and that's going to be interesting exactly for the same reasons. this dollar China, we had a bit of a move higher again, reflecting this doubt about the Chinese revival. But for the time being, we have not tested and not broken either these levels of 711, 712 and a half. So for those wanting to trade China, keep an eye on those ones. And for now, actually, if you look at it shorter term, we are rejecting pretty rapidly this bounce, and we are already back below the prior level here, 708 3/4. So, but I would say wait until tomorrow, the reopening of the Chinese markets, to see a bit clearer. And then another one that we were looking extremely we were looking closely in our room, and I need to go on to the shorter term, is this dollar Swiss. So we saw these big moves lower that we saw down to in August, then this revival. Now, between from this last leg lower, the 61.8 is 85, 86.05, 86.06, and we actually tagged it and we came back down. Now, why is this interesting? Is because we saw the S&P reserves coming out this morning, and they ticked up roughly 3%. Even though, if you look at the month of September, dollar Swiss, for instance, has been hovering around in 1.5%. So there seems to have been some levels where we may have seen stealth intervention by the S&P. Remember that the S&P has told us, whether it was Jordan or Schlegel, said that interventions were part of their policy. Well, I've got the impression that they may have been towards those lows in the dollar Swiss or in Swiss crosses, but we need to respect these levels here and now, and that 86.05 capped on Friday after the jobs report in the US. So respect it, okay? And now we are looking at 85.5, 85.55. That is your first little range here to look at in dollar Swiss. That is just something that I thought worth noting, because we had those numbers as well, those FX reserves numbers coming out for September, and also we clearly defined this 86.05 level. And with that, Ryan, back over to you, mate.
Yeah, thank you very much, mate. Good stuff as always, and once again, good to have you back. Thank you everyone for coming to the Flow Show. Do have a good week ahead. Trade safe, trade well, and we will catch up with you tomorrow morning. Have a good one, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.